Hi, welcome friends. Hey, I'm Dave Etkin. I'm the director here at the Louisville Small Business Development Center. Thanks for joining us today. I'm also joined here with my co-worker and comrade in arms, Claire Bridges. Hey, Claire.
Good afternoon.
So thanks for joining us, everybody. We're always glad to see you. And just to remind everybody, we are with the Small Business Development Center here in Louisville, Kentucky. We are part of a statewide network of centers. There's 13 centers across the state of Kentucky. So you can always find a center near you if you need some help. But if you'd like to contact us at any time, you can do so at our website, louisvillesmallbusiness.com. We'd be happy to hook you up with one of our coaches to help you out. And since we may have had a little bit of a technical difficulty there, I want to make sure that everybody can hear and see us well. If you just look to the bottom of your screen, you'll see a toolbar. And if you don't, just take your cursor and hover down there and it should pop up for you. And there you'll see the chat button. If you click on that, and then the chat bar will pop up on your right, and just type in your name and tell us where you're joining from. And we're always, I'm always really curious where everybody comes from, and that you can just want to make sure you can see and hear us. So there's Rhonda for Crestwood. Hey, Rhonda. Hope you're doing well today. But hey, Dave, I need to talk to you. It's good to see you online as always, but I do have something to chat with you about. So I'll hook up with you later on today. So for those of you who don't know, Dave owns the Sauerback Family Drive-In Theater out in Oldham County. Great place. Was there not too long ago. Always a great time. So check that out, everybody. Shannon Maxey. Hey, Shannon. Saw you last week. Good to see you again. So yeah, there's Lisa. Hi, Lisa. So it looks like everybody can see and hear okay. All right. We had been talking quite a bit, and one of the things that has come to mind to me and a lot of us here, that as a small business owner, you are so focused on your business and so driving things forward, that you often forget about a couple things that are really important. Number one, really, instead of just pushing things forward with your staff and your team, what can you do to help them have better lives and make a difference in their lives? And then secondly, taking care of yourself and your family and your family's future too. We do sacrifice a lot for our business, but sometimes in that sacrifice, we sacrifice ourselves, maybe too much. But so we've been talking to our good friends, Dylan Cole, who is a certified financial planner with CoreFit Financial, part of Northwestern Mutual, and also Allison Luckett, who is with KIW Insurance. And so we brought them here because they have a lot of great resources and expertise that they can share with you, how to set things up correctly for yourself and the people you work with and their families. And that's what it's all about. It is about being successful in business, but it also is, life's about making a difference in other people's lives as well. So I think this is a great thing that that you can share with them. So hello, Dylan. Hello, Allison. Glad you could join us.
Hello. Yeah. Hey, David. Thanks, David, Claire, for inviting us today. And we're happy to be here. And Allison, I'll let you introduce yourself and you can kind of kick us off here.
Sure. Hi, everybody. My name is Allison Luckett. I'm a independent insurance agency owner. So I'm a small business owner, just like you guys. And our agency focuses on, and we do employee benefits as well as working with your business insurance. So I know that we had talked today about coming together to kind of go over employee benefits and what that package kind of looks like. So Dylan, do you want to pull up that PowerPoint? Are we there?
Yeah.
Okay.
Let's get started.
I know insurance isn't the most exciting topic for everyone, but we'll try to make it as fun as we can. And then if you guys have any...
When you needed it, it is exciting.
It is. It's very helpful when it works, right?
That's right.
Fair point.
All right. So, some of the things people want to think about when they're going to offer a benefits package to their employee is, why do they do it? There's a couple of reasons why you want to do it. It's, the recruitment and retention of employees goes along with the reducing turnover and just your general workflow. It takes a lot of time to find new people, train new people. So if you can provide just a really good working package for people that is supplemental even to their paycheck, that is a benefit to them, it's a good way to recruit and retrain employees. Um, I don't know that I've ever had anyone, actually, I have had employers say that before they offered benefits of some kind, that they were having trouble getting employees to come and work with them. So we're going to just go a little bit over about how you can do that and what does a package look like. So Dylan, if you want to move on to the next slide. Generally, an employee benefits package is going to have in its core medical, dental, and vision insurance, life and disability, of course, and then there's Dylan's specialty, which is retirement plans, 401k. And then we also have different options for wellness programs and different supplemental worksite plans that employees can take out. You don't have to start with health insurance if that's not in your budget. There are many things that you could do to implement at least a starter benefits package for employees that may not even cost you anything. Want to go to the next one? What are the pros and cons? All right, let's bring it on, Dylan. Of course, it improves recruitment. It also improves retention. And to you as an employer, there's also tax benefits to it because the premiums are generally that are paid by you as the business are generally a tax deductible expense. And then also anything that your employees are taking out that are on a pre-tax basis, like medical, dental, vision, some of the supplemental policies, any premiums that they pay that are pre-tax can save you money on your matching FICA. So it can end up being, depending on how many employees you have, it can end up being a pretty significant savings in the taxes that we as business owners have to pay. And then, of course, the con, it can be expensive. So depending on the employees that you have, where you're located, and the types of plans that you offer, it could be expensive to do it. Especially when you implement health insurance, it can be expensive. But the only thing that the employers are generally required to pay for is 50% of the employee only premium. So most people think, oh no, I'm going to have to pay for this whole family's coverage. You don't have to. The only requirement is 50% of the employee only on the medical insurance. Everything else can pretty much be completely on a voluntary basis by the employees. Here's some sample costs. So this group here, they have 10 employees and they have a health insurance plan that's through one of the programs that Anthem has currently through the Chamber of Commerce, through the Kentucky Chamber and all some affiliated chambers. And this group has a very nice medical plan. It's a $2,500 deductible, $5,000 maximum out of pocket. It's got co-pays when they go to the doctor, so everything's not going straight to that deductible. And this is the gross premium for that group. So for under $400, the employee can have health insurance, and you as a business owner would pay roughly $200 a month for that plan. So this is a very, very competitively priced plan. They don't all look like this though. So Dylan, if you want to show the next one. This is an average rated ACA plan. So this is with the ACA rated plans, there are no medical conditions that are considered. So your employees are only rated based off of the average age of your group and the zip code that you're in. So with this group, I believe the average age was 45 years old. So you can see the difference in premium. So it's really important that you work with someone who is well versed in the market that your group is in to help find the best plans and take advantage of the different programs that are out there. So who do you want to work with for medical, dental, vision, those types of things? You need to work with a licensed insurance agent who is licensed in life and health insurance. And then for your retirement benefits, you want to work with someone with a securities license, someone like Dylan. That's he's got way more certifications on that side of the business than I do. So we work very well together as a team to help make your company have a great package. So when you're considering at the end of the day, what type of brokerage or partner you want to work with for implementing your benefits packages, how much work do you want to do? Do you want to do all of the day-to-day administration, making sure employees get enrolled, filling out paperwork, processing ads and terms? And I have so many times where I find where, especially in small businesses, the employees will come to the owner or whoever got lumped into the quote HR role and they start having to answer questions about medical coverages, which is what I personally prefer that you not do, because that's what I'm licensed to do. And I don't want anyone to ever feel like they could potentially give out wrong information that could impact someone's health care. So it's really important that you think about those types of things when you're partnering with someone who's going to put together your package for you. There are different brokerages and agencies and agents. They all have different level of services that are available. Sometimes they're restricted by their corporate offices, as far as like if you only have 20 employees, we can't. Your employees, once we implement it, you're going to have to call an 800 number for service. So it's really important that you do some investigating with the type of relationship that the broker that you're working with can help you with. And then, we do in my office, we do commercial lines also. But is it absolutely necessary that you work with your commercial lines, your general liability, your work comp, those types of agents and agencies? Is it essential that you work with them? It depends. I mean, you can have a level of comfort that maybe that agency and you want to stay with that agency, by all means do. But I just want to make sure everyone knows that it's your commercial lines coverage and your life and health insurance lines of coverages, they don't really necessarily need to be with the same agency. Some agencies don't do both, but it's just really a level of comfort, but it doesn't impact your ratings or your ability to have coverages to make sure that you stay with that commercial lines agent. But we all appreciate loyalty. PEOs. What is a PEO? So it's a professional employer organization. They're generally offered by your payroll companies, like ADP offers one, and I think Paychecks and Paycor do. I'm sure there's some other ones out there. What the benefit to those is that they will be able to take away some of your human resources responsibilities, like payroll and benefits and potentially your workers' compensation. So it's good that they have that if that's something that you absolutely need. But when you do enroll in one of those, you lose a lot. You're going to lose the touch for your employees. Most of your stuff that you're going to work with is going to need to be resolved through an 800 number. And there's not as much transparency in the rates and the different costs that you have when you're working through a PEO. But if it's absolutely necessary, please do. I still have the question, will any of this be applicable to an LLC or an S Corp with only one member? Generally, the health insurance companies require that you have 2 employees that are eligible. You could have one owner and then one waged employee is what they need. And only one of you would have to take coverage. And then on to retirement benefits. Dylan, this is your area of expertise.
All right. Good work, Allison. So I'm a financial planner. I have a team of 6, CoreFit Financial, and we're affiliated with Northwestern Mutual as our broker dealer. And we work with a lot of business owners because it's just relevant to our situation. So I have a partnership. There's another advisor on my team, and we have a team of 6. So we are a small business affiliated with a larger business, but we understand all the navigating the different benefit offerings and for our employees, for recruitment and retention strategies, and also looking at on a personal level planning versus business planning, like how does that overlap and how do we separate it a bit, help with cash flow management and exit planning strategies. So we're always thinking through that for ourselves, for our practice. So it's just relevant conversations with those that we work with. Now, when it comes to wealth accumulation, we find that majority of our clients really have 3 segments to their overall wealth building picture. The first segment would be what we qualify as their home run segment. So their home run segment, this is typically going to be their business, right? This is what they know best. This is where they're plugging away majority of their cash flow. They're reinvesting it back into the business, maybe acquiring property, taking on marketing expenses, hiring somebody new, setting up benefits to help with recruitment and retention. But this is the primary focus for where they're going to be accumulating wealth. Now, we're all for that. We do the same thing with our team, but for diversification purposes and some tax benefits, oftentimes it makes sense to have some other buckets as well. So the home run segment, then there's the aggressive segment. I say aggressive segment because this would be investment accounts, invested in the market. Now, if it's invested appropriately, not talking penny stocks like Wolf of Wall Street, it's more calculated risk. We don't have to be aggressive. We can be conservative and still be building wealth, at a faster rate than just plugging away dollars into a savings account. Now, we're not bringing this up to say, hey, this is going to beat the rate of return of you investing more money back into your business. If you know what you're doing there, that's going to be your best opportunity. That's going to be your largest rate of return. And whatever you're building, an enterprise or your exit strategy, that's going to be your primary wealth picture. But within this aggressive segment, there are 2 different types of accounts that you can use. There are what's called qualified retirement accounts. So qualified means there's some type of tax qualification to them. So oftentimes using as a tax benefit. And then non-qualified investment accounts. And this is where they're completely liquid. We have access to that account anytime we want to. We just want to get higher rate of return on that cash than setting it aside in the bank account. So we have the home run segment. We have the aggressive segment, stock market based accounts. And then we have the safe segment. It's important to always make sure we're maintaining a certain amount of cash for that next opportunity that comes available. Maybe we want to dish out a bonus to hire on somebody to join the team. And that's going to be incentive for them to take a jump start and move from one career over to your team right away. Or it's investing in a new property that comes about that we all of a sudden want to get involved in. So we want to have a cash position for that and for, emergency fund reasons, but not tie up all of our money into an account that's, typically not outpacing inflation. So today we're going to take a little bit of a deeper dive into the different qualified retirement account options that we are typically helping out business owners with. But first, let's talk about some of the benefits of retirement accounts. So I mentioned there are some tax benefits that come with retirement accounts. This can be for the employer and for the employee. So if you're setting up a retirement account, you're helping out yourself. So that's providing an opportunity to help out with that retirement picture as well, building wealth that you can access later in life. But you're also doing the same thing for the employees. We'll talk about opportunities to where you can contribute money into their account, but just the fact that you're setting up this retirement account opportunity allows them to take advantage of that and contribute to their account personally to be able to better their retirement picture long term. Now, there are 2 different tax benefits to consider typically when it comes to retirement accounts. Either pre-tax tax benefit or Roth tax benefit. Pre-tax contributions to a retirement plan, that's going to feel good today. When you put money into the account, you get a tax deduction. It's pre-tax money going in. Now that money grows tax deferred. And then when we pull it out in retirement, that's when we're paying taxes on it. Now, this is oftentimes very appealing for a lot of business owners that we work with because they're always wanting to find tax deductible expenses to write off. And this is going to be similar write-off, right at the top, above the line deduction that you can write off, but it's not actually an expense. You're just deferring your income into it. You can actually retain that income, grow that income, and access that income later. So we're not losing the income to an expense. Roth contributions, on the other hand, you don't get a tax deduction for making that contribution. However, those dollars then grow tax-free. So let's say you've put in over a certain period of time up until retirement, 100,000 into a retirement account Roth, and you go to retirement and you see your balance and it's now built to, 400,000, you're accessing all of that tax-free at that point in time. Helping with incentivizing recruitment and retention. So recruitment, just having another benefit item added to the benefits packet to be able to bring up to them. It's a great opportunity there. Now, helping with retention, depending on the retirement account that you set up, there are opportunities to incentivize staying with you longer. So you can, one thing is offering a matching contribution where you're putting money into their retirement account, and that's a deductible expense for you. So you're basically paying them, but it's going into that retirement account. And if they stay there for a period of time, that would be the vesting schedule, then they are 100% vested in that money. Meaning if they were to leave, they get to take that money with them. But if you put it in right away, you offer a matching contribution, but you set a vesting schedule where, hey, you have to be with me for 3 years before you get to take this money with you. If they leave before that 3 years, you get that money back. So helping with retention strategies. Let's talk about some common retirement accounts that we see set up. The first one would be traditional IRAs or Roth IRAs. Now, this isn't specific to a business owner. Being a business owner, you have access to more retirement account options that you can set up, but a traditional IRA or Roth IRA is available to everybody. Now, being a business owner, this still might make sense to be the best option for you at this period in time. It depends on a couple of things. The biggest thing is how much do you want to contribute to the account? So this option is going to have the lowest maximum contribution limit. So you can see this is for listed here 2024. The max you can contribute to a traditional or Roth IRA is $7,000. Now, you can also have traditional IRA and a Roth IRA. And to take a step back, the traditional IRA would be the pre-tax option. Feels good today. The Roth IRA is going to be the Roth growing tax-free, feels good down the road option. But total aggregated contributions for the year have to be below 7,000 or right at 7,000. Now you can put in $1 if you want to in a given year. If you're over age 50, or actually age 50 and above, you can make what's called step up or catch up contributions to retirement accounts. And the additional amount you can contribute is a little bit different for each of the plans. But as a recap, you can have both of these, traditional IRA and Roth IRA, but total contribution limit for the year, max is going to be $7,000 or $8,000 if you're over 50. pretty simple plan there. You can't set up any like matching contributions or anything like that. Next option, a SEP IRA. I commonly see this as the best option for the sole proprietor or individual business owner that doesn't have multiple W-2 employees. This is going to offer, typically, depending on income, a larger contribution limit. So you can contribute up to 25% of your income, up to a max of $69,000, $76,500 if you're over age 50. With the SEP IRA, you're only going to have access to the pre-tax option, which might be fine. Maybe that's what we're looking for, but there won't be a Roth option available. All the IRA options that we'll go through, you'll see a common theme. It's very simple to administrate and a very low cost for it. Depending on where you set up the account, whatever broker dealer you're using to help establish this account, it's going to be anywhere from $10 to $100 in a year for the administration cost. Now, with the SEP IRA, if you do have employees, and when I'm bringing up employees in this conversation, I'm referring only to W-2 employees. This does not apply to 1099 contracted employees. If you have W-2 employees, whatever you're contributing to your account, you have to contribute to their account as a percentage of your income. So let's give you an example. Let's say you're a business owner, you make $200,000 a year, and you contribute this year $50,000 into your SEP IRA, and you have a W-2 employee that you're paying them $100,000 in a given year. They don't get to contribute anything to the SEP IRA. You're the only one that can contribute to the SEP IRA. In that situation, you need to contribute $25,000 to their SEP IRA, because that's equal to 25% of their income, because that's what you did. 50,000 of 200,000, 25% of your income. You need to do the same for them. Couple points to include. Who do you need to include into this plan for W-2 employees? They have to be age 21 or older. Now, if you have somebody younger, let's say they're a W-2 employee and they're 19, you can include them into the plan. This plan design is talking specifically about who do you have to include into the plan, or else it's not going to meet the IRS's guidelines. If they're earning at least $5,000 per year and they've worked with you for the last 3 years, or sorry, 3 within the last 5 years, they've been working with you. You do need to include them in the plan. Simple IRA. All right, another IRA here, so very simple to administer and low cost. The annual contribution for 2024 is $16,000. Before I forget, I want to bring up a point that I get asked about a lot. When I'm talking about the contribution limits, right now I'm illustrating for 2024. You have the ability to set up any of these options today and still contribute to them for 2023. You actually have the ability to make contributions for this year all the way up until your tax filing deadline for this year. So if you're filing in, if it's April of 2024, April 15 of 2024, you just need to make sure the contributions get in there before that deadline if you want it to count for 2023 tax situation. If you're filing in October of 2024 for 2023 tax year, you can get the contributions in anytime up until October. Now, some plans, you do need to get those contributions in by September 15th as a firm deadline if you're filing that extension to October. But contribution on the simple IRA, 16,000 if you're older than 50 and above, 19,500. With this retirement account, you do have pre-tax and Roth options available. The vesting has to be 100%. So if you set this up and you're funding an account for an employee, immediately they have to be vested in any contributions that you're making or matching contributions. So if they leave, they get to take that money with them. The next plan we'll bring up is where you can get more tailored on that vesting schedule option. The matching contributions and contributions themselves, the employer can make contributions to the employee's account as well as the employer's account too. And the employee can make contributions to the employee's account. The matching contribution options, there are two. So the first one would be you can set up a matching contribution. It's going to be dollar for dollar matching contribution on any employee's contributions up to a certain amount of their pay, anywhere from 1% to 3%. You can choose that. It can be 1%, 2%, 3%. So if you say you'll match dollar for dollar, anything your employee contributes up to 1% of their pay, well, you can safely assume your payroll increase is going to be about 1%. That's assuming all the employees are maxing out the matching contribution. That assumes that all the employees are contributing to their retirement account. If you don't want to offer a matching contribution, but you do want to contribute to employees' accounts for them, you can do what's called a non-contributory contribution. That is just a flat 2% of their pay. So if you have an employee, you're paying them $100,000, expect to put $2,000 throughout that year into their plan if you're doing the non-contributory contribution. The people that you do have to include in this plan is pretty similar to the SEP IRA option. A little bit different here. There's no age requirement, but anybody that earned at least $5,000 in the prior 2 years, you have to include them, and that's assuming they're expected to earn at least $5,000 this current year. You can help out with the retention strategy by delaying enrollment, but not changing the vesting schedule. So what you can do is you can set up a simple IRA with this one. Employees can contribute to their IRA, and you can say, hey, once you've been here for a year or 2 years, we'll start matching your contributions to help with retention strategies. 401k. So this is where there's a lot of overlap, but with the 401k, this is where we can start getting more tailored. We can really design the retirement account however you would like. Now, there are what's called safe harbor 401k plans where you have a model, like a template 401k, and that might be the best option for you, what you want to use to match and what your vesting schedule wants to be and how long employees have to be with you before they get to contribute and how much you're matching on contributions to this type of employee or this type of employee. We can get more descriptive here. Contribution limit is $23,000, $30,000 if you're 50 and above. You do have pre-tax and Roth options available here. Vesting, you can set in place, and there are two options for vesting schedules. One is called a cliff vesting schedule. With a cliff vesting schedule, this is, I'll give you an example, a 3-year cliff vesting schedule. What does that mean? You're matching contributions to an employer's account, and they don't get vested, meaning that's not really their money until they've been there at least 3 years. If they stay with you for 2 years and then they leave, well, you get that money back that you put in there. That's a cliff vesting schedule. Graded vesting schedule on matching contributions would be, say, 20% grading over 6 years. So if you've been here for 1 year, you're going to get 20% vested in the contributions that I, as the employer, have contributed to your account. If you've been here 2 years, you're now 40% vested. 3 years, 60%, so on and so forth, until they're 100% vested. With this being able to be tailored and more unique to what you want it to be designed for, is also going to come with some more annual filing to make sure that it is compliant with IRS guidelines, and it's going to have a higher cost. You have to hire a TPA, a third-party administrator, to do your filing 5,500 and make sure that the plan is in compliance each year. Now, the TPA will do all of the work on that, but because they're doing that, it's going to come at a higher cost. We were talking about the IRA options being about $10 to $100 a year. The 401k administration is going to be, on average, like first year, probably $1,500, $2,000. On an ongoing basis, somewhere around $1,000 to $1,500. Now, there are some tax credits and tax deductions available for that administration cost on a 401k. If your business qualifies for it, which most businesses do, you can actually get a full tax credit for that in the initial setup. This is something new that came about actually in December of last year in the Secure 2.0 Act, where the IRS is encouraging more businesses to set up 401ks and retirement plans for their employees. So I wouldn't let the cost hold you back there, because a lot of that you get recouped, and we can talk more about that one-off, or I can share some information with you about it. So that would be the most common retirement plans that we see set up. Now, there are some other additional retirement accounts that are considered. A profit sharing contribution would be, you're not setting in place a specific match. It's similar to a 401k, but you're not saying, hey, I'm going to match dollar for dollar on your contributions up to 3% or something like that. You get to hold a discretionary position, which says, at the end of the year, based on profit of the organization, we will offer a percentage of that net profit to your 401k. We're going to contribute to your 401k at a specific percentage of our net profit as an organization. With the profit sharing plan, this is an opportunity to incentivize or tailor towards more highly compensated key employees and executives, and yourself included as the business owner. Cash balance plan is going to be a similar. It's just offering an even higher contribution limit. Now, this one's a little bit more complex because it is a 401k-like plan, as in it's a deferred contribution plan, but it also works and acts a lot like a pension plan, to where there is a required minimum funding for at least 3 years. But a cash balance plan is going to allow you to contribute the most into this retirement account. So we'll see a lot of business owners stacking plans. Like if they want to put away more and more money into their retirement account, you can stack on a 401k with a profit sharing plan and a cash balance plan. And maybe we're putting away $450,000 a year into these plans combined, all tax deductible to you. And you can tailor it to where maybe about 430,000 of that is going away to your actual account. You're retaining that. So getting about a $200,000 tax savings, deferring that income, and also incentivizing employees and helping with recruitment. Non-qualified deferred compensation benefits would be tailored towards the highly comped, or if you want to just set up a benefit just for one employee in particular, or this group of executives, but you don't want to set it up for everybody. Those are plans you can use. And then defined benefit would be more of a pension plan, which we don't commonly see anymore being established. So I know we want to leave time for questions. I can share over the slides after the call. I know the recording's going to go out. I wanted to include this. I love flow charts. I love flow charts to kind of digest what we've gone over today, but help pave a roadmap for you to consider, or questions to ask yourself to arrive on the appropriate plan that you would like to set up. And then here's our contact information. How are we doing on timing, David, Claire?
We are doing well. We've got enough time for questions. So if you have any questions, put them in the chat. And so let's see. We do have a question from Dave Sauerbach. He says, as a small business S Corp with 4 owners, 2 non-paid and only 1 owner with full-time salary and 1 owner with part-time salary, all employees are part-time, mainly high school and college age. Are QSEHRA or ICHRA plans a cost-effective approach offering health benefits? What if only an owner ends up wanting to participate? Does that make the business ineligible? Are these plans managed by the business owner or companies like KIW? I guess that's you, Allison.
Yeah, those are managed by the business owner.
Okay, so explain that a little bit more.
So with those plans, you're basically giving people money to select their plans. And then that would there are third-party administrators that would manage the legal documents for you that you would need to get set up. But the day-to-day administration would be handled by yourself. I mean, we could help people pick a plan. The administration of the actual Q-share plans and the ICHRA plans, there are companies that will actually create those documents and make sure that you're compliant for those.
Okay. Sounds like a big job.
But you always want to, anytime you're dealing with any kind of compliance thing, you want to make sure that you have, a resource available that's going to help you manage those. And, those require special tax forms to be set up. So there are vendors out there, and I have resources for you if you'd like one.
Okay. So if anybody has any quick questions, you can put them in the chat there. So Dylan, you were mentioning about stacking plans. I mean, do you normally recommend doing that, even though maybe a business owner might not be able to pull out, too much cash in the beginning, but is that a good idea to set that up early on or as soon as possible?
I would only stack plans when it's necessary. If it's something that you want to do, you don't want to set up a plan just to have it there for the future, because then you have to cover an administration cost for that plan, which, it doesn't have to be. Some of the plans are very low administration costs, but still no need to take on an additional expense if it's not something we're going to do in this year. Now, if you want to make a contribution to this plan, you can establish a plan depending on the one that you set up. A safe bet would be within 1 month and be able to fund it. So we can just wait until that point in time and set up what's appropriate for today. It's very easy to change from plans. So, for instance, our team, we had a simple IRA 2 years ago. And then we decided for a couple reasons that a 401k would be a better fit. So we just stopped the simple IRA contributions. We moved the simple IRA balances over to the 401k and started funding there.
Okay. This is a good question from Gregory. Do you have a strategy for the owner of a business offering a 401k, but the owner is limited to 1% contribution due to top-heavy test limitations? Often highly compensated, successful owners get penalized when it comes to retirement savings. That's very true.
Yes, that would be a common situation where we see a cash balance plan design being a great solution to look at.
Okay.
Usually that's going to be the type of situation where we might just want to set up the cash balance plan. And then sometimes there's like, hey, we want to set up the 401k. Now we just want to open up the door for more contributions. So then we stack the cash balance plan. But sometimes it makes sense to do cash balance plan only.
Okay. Going back to that discussion, especially like on the profit sharing, I mean, how would you set that up for a business owner? What would you recommend the structure be for a profit sharing plan?
Good question. I mean, you would want to look at what the way that we'll do it is like, how much are we going to have in net profit? Like if everything stays the same throughout this year, and how much do we want to budget for future expenses next year? So let's say net profit this year, if we keep everything the same, is 100,000 coming into the business. But next year we want to hire an employee that's going to cost $70,000 a year. Well, we want to only consider a profit sharing plan that's going to take up about $30,000 max, like structure the profit share based on that additional surplus to be able to give to the employees into their 401ks at the end of the year.
Okay.
So map out the expenses for next year to know what else you want to set aside for future expenses, and then net of that, that's where you want to consider to use it.
And then just use easy numbers. If you have 10 employees, I mean, and the profit sharing is then the way it's just distributed amongst the employees is up to you as far as, you know, weighting or how it's structured, or what happens after that?
So it's going to have to meet the guidelines of the top heavy rules. So if you do have higher comped individuals, they're capped out at a certain percent. But let's say it's it's equally distributed to all employees, but as a percentage of their income. So let's say the pool that we have for the profit share is $100,000. It's going to be dispersed to all employees individually as a percentage of income. So if it's 1% across the board, but one of the employees makes 100,000 and another employee makes 50,000, it's going to be higher for the higher employee, higher comped employee than the lower comped employee until that balance is depleted.
Allison, here's a question for you. We've heard a lot in the news, especially about, Humana exiting the health insurance market and stuff. I mean, how hard is it to find health insurance for small business owners and maybe their 1 or 2 employees?
The problem with Humana exiting the market is that it just limited the upfront options that we have to go with. If you're looking at a company that has, less than 5 employees that are enrolling, we Anthem and United Healthcare are really our only options as far as actual markets to go to. If you have, with Anthem, that competitively priced plan, the very competitively priced plan that I showed earlier, that was a Chamber Advantage plan where that is one where you can enroll one person as long as you do have one other waged employee. So is it a challenge? Yes and no. I mean, they were all pretty competitively priced with one another. As far as, with Humana United and Anthem. So it has caused a little bit of panic with people because they're just not sure what's going on. But we would have looked through all of those carriers anyway, every year to see what's more competitive. And most of the people that are the only people I'm finding that are really having a struggle with Humana pulling out of the market are companies that would have been on the old grandfathered plans, were around before 2013. So those are really the only ones that I'm seeing are having a huge impact about that, with Humana pulling out of the market. But we always do our best for people to find what we can.
Mhm. Allison, are there other options that are not traditional health insurance that can be used?
Yes and no. From a truly, I mean, like the Q-Share plan that the gentleman was asking about earlier, you can, and the ICHRA plans also, you can use those to help pay for individual policies. Or the only challenge I find really with those is that, one, in the individual market, the plans are rated almost identical to those in the group insurance market. So I would strongly encourage people to not just say, oh, I'm going to tell my employees to go get individual health insurance, because most of the time you're going to end up paying actually more, most of the time. And the networks are different. And, most of the time the plans in Kentucky and really all of the exchanges is where they would have to get their individual health insurance, is that most of those plans only have coverage inside of the state of Kentucky. So if they were to, like, I mean, if there was an emergency and they were in Florida, there would be coverage, but you can't just go to the Cleveland Clinic and go get treatment if you wanted to on those individual policies. So it's, it really is important to try to do whatever we can to work with each company individually. And, there's options. We can usually find something to help.
Okay. So Allison, here's a random question, and maybe you can help me with this one, because I've been struggling with this a little bit, but some businesses I'm involved in, we have our normal, business owners liability insurance / and then I like to add an umbrella on top of that. And it seems like the umbrella market has gone a little nuts lately. So have you seen that? And is there anything changing there as far as availability and pricing?
Not so much availability, but pricing's. I've seen it go up everywhere. Especially, all of the carriers are taking rate on all of their coverages. Just with all of the claims that we've had this year, every single carrier has taken on rate, and the underwriting is getting more strict, and so it is a challenge. But we can find you coverage, and we'll, even if we have to find you something that will work just for now while this market is in this state. We keep our eye on that to know that, hey, the rates seem to be lightening up, or we're finding that this carrier is starting to like this type of industry better. So we can get you coverage.
Okay. Are there any issues with Kentucky? Like I know in Florida, there's issues about insurers just exiting the market. I mean, we're fine here. There's no issues with our area, correct?
Not that I'm aware of. No, I'm not heard of any carriers truly pulling out.
Okay, great. Other than Humana in health insurance.
On the property and casualty side, yeah.
Sure. Okay. Yeah, let's see. I think that's about all the questions we have. So Dylan, Allison, I really appreciate this. This is when you say, hey, we're going to talk about insurance and retirement stuff, it's like, whatever's kind of drab. But, this is really interesting stuff. And there's just so many ways to protect yourself and your employees. And, that's what it's all about. It's quality of life. That's why we go to work and do what we do. And it takes a lot of time.
I do want to share. So as Allison was talking, like I want to get so far into the weeds with specific situations because everything is so situational. And Allison, I know you're itching at the same thing when we were talking prior to this, but Allison does a great job of just like reach out to her, ask questions, provide your situation, and she can tailor what would be appropriate for you. That's why we've gotten along so well. I take the same approach. More than happy, like welcome questions, can have a talk. We've introduced a bunch of clients to Allison and family and friends. So
great. Oh, I just thought of a question I should ask real quick. Allison, insurance wise, everybody's, when you do succession plan your business, everybody says, well, what happens when you get hit by a bus? That's a great way because it's all final. But what could happen is you maybe get hit by a bus, let's say, but then you're disabled for years and years and years. I mean, that's probably more likely, I think, to have happen. And that's more detrimental to the success and continuation of your business than you just suddenly dropping dead. But so there's insurances for that. Would you talk a little bit about what you would recommend there? And is that something you can help people with?
Yeah, definitely disability insurance is very important. Um, if the owner is just, I don't want to say just disabled, but if they're, disabled or, a key person is disabled or, doesn't pass away, the only real way to truly fund that is if they do pass away with a key person insurance policy. That's really important that you should have that on your owners and your key people. I mean, a lot of times people think about only having it on the owners, but if you have an employee that is essential to the flow of your business, um, you know, I highly recommend getting a key person policy for that person, because it can replace their income to the business. The business is the beneficiary at that point. That way you could have the money coming in to help pay for somebody else during, after an event like that.
Great. All right. Well, thank you guys. This has been spectacular. And
happy to be here.
Has enough. Yeah. So I
Thank
encourage
you.
everyone to please reach out to Allison and Dylan. They are great experts, great help. And we will, Maureen, just to put a pin in there, we will send everybody a recording and then have it up on our YouTube channel so you can watch it over and over again. So this is a great resource. Please reach out to them. Allison, Dylan, thank you. Claire, as always, good to see you. Thank you. And we'll see you guys next time on next week's Toolkit Tuesday. Have a good Tuesday.
Thank you. Bye-bye.
Thank you.